Hello, everyone. That's a interesting little report we've had out there, isn't it? From the payrolls. Surely, they think they've made a mistake not going now. Obviously, market's a little bit all over the place, but that should start to change the narrative a little bit. We've been talking about it for weeks. People are starting to talk about it today. I think we're on it. That if you leave it too late, by the time you start getting the data coming through, you're way behind the curve. Then you have to go bigger. Then you've got more chance of making errors, of being forced to do things when you should be in control. They should have really put 25 basis points on in July. Just carrying on. I don't know what they're actually waiting to see. But you've now had ISM and non-farm payrolls for July both showing road crash in employment, which is hurting new orders. There is no tension left in the market without supply chain issues, which there aren't many left. And it won't matter if no one's actually trying to buy your goods because you won't have to make them. Inventories going up. I said that in GDP that only bounced really because demand was rebuilding inventories. There wasn't actually super demand out there. Retail sales were fairly flat. That was all coming through. Now people are telling you now manufacturing's only 20-25% at best of the US economy. 85% of jobs are coming through from what do you call it? Manufacturing jobs. Hi, I presume my unmute didn't work there. We're starting to get to where we need to be. The July data is deteriorating quickly, which is like what we said. Hi, Julie. Good to see you. You can't beat a double dose of Planty, can you? Bookend in the weekend. Hopefully, this is obviously a growth scare, which is why all the stocks started getting beaten up yesterday, etc. It's not just the tech stocks, and in fact, people perversely might actually start going back in and hiding in some of the large caps of those. Seasonality, the Russell, the value plays that we've been rotating into struggle at the start of July, start of August anyway. But this is an across the board scare. The Fed are behind the curve, which the market is now going to try and force their hand by putting a smash in. Obviously, I just was trying to say on mute, 85% of the economy is services in terms of jobs, but the direct read through from that report, less than 100,000 private payrolls. ADP predicting the direction midweek, saying it was construction. There was very few government jobs, so it really is sector slowing down, and we are seeing that from the earnings season. That 3 out of 4, 5 out of 6 of the major players in every sector are talking about weakening demand, less pricing power, etc., and all that fed through in the manufacturing report yesterday for ISM. What those employers were saying, that data is deteriorating. So there's a good chance you guys may or may not have seen this over the years, but they don't have to go at the meetings. They will, if things are bad enough, they will come out and just at any point hold a meeting and say there's an emergency cut. I think the market was starting to talk along those lines today. We were talking about it a couple of weeks ago, and now we're starting to get the data that makes those sort of things happen. So just be careful about getting too negative when we've already had quite a big pullback, because you might the rate cut may be a surprise to the upside. Now gold, we'll talk about that, but that's obviously going to have a big jump. What we talked about, no landing, soft landing, hard landing. This is the very definition of hard landing when you've got the central bank out of kilter with the economic conditions. They have to go 50 basis points plus as a starting point to play catch up. And because they're playing catch up, everyone thinks they're going to do too many cuts and maybe create an environment where they get it wrong and inflation comes back. That's good for gold. It's the uncertainty and the fact that it's going to see more rate cuts than first thought and see them in bigger chunks. But underlying gold is the demand picture, which we'll go through. If you've not been on the chat today, but it's the usual form, and we're set to have the biggest. If this pace continues, we'll have the biggest gold deliveries of the year. So look out above is the message there. So this, a lot of the doctrine has been: is the economy losing momentum, or is it just weak? And good metaphor for that is that we're traveling around along at 40 miles per hour. Everything looks good, but if the engine's just blown, it's not going to be long before we just start drifting and eventually losing momentum completely and coming to a standstill. Unfortunately, we've got too many noisy people on the Fed that have managed to keep the meeting rhetoric a little bit on the back foot, still looking for more and more evidence. I think it's a little bit crazy, but that's the way of the world. I still think the makeup of that will change when Powell makes them change. The net of them are doves, so when they need to make a decision, they'll be able to get it through. It's probably coming ahead. I mean, this is all crazy, really. We've put it in the mix in the last few weekly updates, but 3 weeks ago, people were talking about rate cuts. We're going to be so supportive of credit conditions and blah, 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 absolute milk and honey. And now it's rate cuts are coming faster. It's the end of the world. The economy's somewhere in between those two, but certainly the Fed are starting to look a little bit silly when they had the moral high ground and should have really have moved just as things came under control. If they're telling you that the reason they're not cutting is because the employment market is back to normal, well, why rates going back towards normal? Now you've got a scenario where it's less than normal. Time to start panicking. As I said, the numbers could have gone either way, but the unemployment rate was the one that we needed to be looking at, and that jumped to 4.3. But it is very much, as we've been looking recently, it was a close to 4.25 rounding up. It only just got over the halfway, so it's not quite at 4.3 yet, but it's a lot worse than they expected. 4.1, put it that way. Boom, boom, boom. So yeah, the mantra for central banks has been this whole one cut per quarter for the rest of the year. Well, the bond market is telling you it's 90 basis points plus for the US by the end of the year. The 2 years jumped down, the yield dropped down 25 basis points instantly on that, basically telling you that they're expecting a rate cut straight away. So it's going to go that way. It's going to be very difficult for the talking heads to pull themselves out of this one. So it won't be. What you've got to remember is that equalisation of rates. They need at least 150 basis points off in quick order if they are behind the curve, which means 50 basis points per meeting probably for the rest of the year. That might become the new backstop, in which case we'll get very quickly a valuation understop, doorstop, backstop, stall, you name it, something to lean on for the rest of the year. We may well here have brought forward a little bit of the late August, September seasonality, or it may just be the fact that we put in the high we were talking about, but we should start to dig in as this will pressure people, because a lot of people say a payrolls number of over 100,000 is a good run rate underneath, which it is. But what people are really looking at is the deteriorating trend. Sean and Bletchley, welcome. The dollar should be in retreat. As you said, we were waiting for that wave 3 impulse drop down, and we started to get that today. We've now got a lower low, haven't we? So it's all moving towards plan, that 3 level, and possibly below. If people start believing this whole change in rates, it's not about just bringing the rate forward. It's going to be a higher amount of rates required. Right. So the order of 50 basis points is what people will be talking about. Now, I just mentioned, if we go back to pre-pandemic levels on rates, which is quite a way, we're not going to go back to deflationary levels, we hope, or things have really gone wrong. Remember, that is in the background in China and Asia. The fair value I mentioned last week, people had said is 100 on dollar yen. Obviously, we're still only just under 150. So if the states are suddenly going to have to start ramping, do not stand in the way of that yen train. Now we've got gold deliveries to look at when we go through. And as I said, some of the tech charts are horrific, but they are at the bottom of the channels we've been talking about. It's either extensions. Very much to me look like we're not far away from at least a bounce. We had one midweek which didn't hold. This hopefully is the bottom part of that. but we have introduced a growth scare into things here. There's not as much slowing growth in the tech updates. It's still remained the criticism for CapEx and how much that's costing, but it's the other side of tech that is the issue for Nasdaq, etc. I discussed it in the meeting today. It's the either being idiosyncratically not in the AI chip game, or the one you're not best placed. And Intel, I still don't understand. Maybe I've been dreaming and I've suddenly started dreaming up stuff, but I'm sure I mentioned it to someone. There was headlines out at the start of the week that Intel were doing a massive restructuring based on losing quite a lot of jobs because the results were going to be bad. So I'm quite surprised just how much of a road crash Intel's ended up being. I mean, they're down 20% on basically a 20% miss, which is fair, but a lot of that should have been anticipated going into numbers. But it is as it is. They're apparently not going to pay a dividend for the first time since 1992. So serious stuff. And again, their way out of it is job cuts, which self-fulfills the rate cutting cycle. Because that is, we'll have a look at the data in a minute. There is a little bit of that going on. We said the danger is part-time, full-time. Part-time's been holding it up, but there's not really been increases in unemployed, but that is now starting to get through, which by definition means that they're behind the curve. So I'll just run through a couple of bits of the data just so that I can get on top of it as well from the payrolls report today. Non-farm payrolls quite. Why do you think it's a surprise, Fato? What bits? So the key things we were looking for, well, I mean, talked about the actual civilian labour force that went up by 400,000. So 400,000 more people in it. That's either to take jobs or signing on. And we've seen that the number of initial claims is going up unexpectedly. Up. The 4-week trend is up. Hello, Pav. So we were kind of expecting that number to go up, which is why I said that things could be interesting. But within it, employed people, 70,000 increase, but unemployed went up by like 350,000, which is why the employment rate jumped to that divided by the labour rate, 4.2528. Demographics wise, job lose went up by 314,000. 115 left to go elsewhere. There was 70,000 coming in from re-entrants. New entrants went down. So net, that showed you why you got more unemployed. People actually are net leaving the workforce in a jobs perspective. This is the big one. Part-time work that jumped 346,000. We said months ago that this is the problem, which is why the trend was bad, is that part-time was going up and keeping non-farm payrolls up at the time when full-time was going sideways. Now that's beginning to go down. So part-time still up. Slack work, 160,000 of them. Could only find part-time work another 50,000. So things aren't easy out there, and we saw that yesterday from ISM Manufacturing. They were saying this is why you want to look at all the details of all the reports to give you clues. Is that overtime work was down? They were considering cutting jobs. That's telling you that they'd be dropping part-time people at least first, etc., etc. What else? So I've looked at the other report. Let's have a look at that. Remember, I was going on about the fact that you get revisions and revisions, and we've only had 5 first revisions up since January last year, and only 2 of those actually ended up being a net gain over the 2 revisions. So we had another revision back to 179 from 206 last month for total. And I've actually got it somewhere else. So June number 206 becomes 179, and the May number 218, which originally was 272, became 218, and then it's 216 today, so 2,000 down. So both divisions were down, and that was a total of 29,000. So still all going the wrong way relative to the actual initial surveys. And then this tells you where, and so construction was a positive, as ADP suggested. It's just a lack of real growth in there, isn't it? Wholesale down, retail rebounded. Transport warehousing, that lost 8,000. Healthcare dropped, private education dropped. Leisure, that was coming through. We knew it had slowed down from that May print, but that's bounced back again. But I suppose it is summer. And government fell back to 17,000. That 43 last month propped it up a little bit, but no real help this week. So that's always a key. That shows you the trend. So 3-month average, you can see that even if it's just falling at the total level, it's still coming down. The private, that's really dropping, and that's the service side thing that's supposed to be keeping us up. So that's a quarter lower than its average 3 months ago. Sorry, than last year. Sorry, this time last year. There's only so average weekly hours went down. That again, that's telling you that overtime stuff is being slashed. That's a small tick down, but it tells you that things are loosening up. The weekly earnings change was only small. So yeah, net, that is 2 days of weak reports, which should be, as we said, supportive overall. Once things settle down, people start. So this definitely put September on the card. The problem we've got is 17th, 18th of September. There's still another non-farm payrolls and 2 CPIs and everything to get through, which data dependent. I mean, it's got to be the trend that you look at. You can't just come out and say the very last piece of data was not suiting the idea, so we just let everything go down the pan. Very odd. All right, where have you gone? Where have you all gone? PAV, beautiful non-farm payroll. Yeah, the 2-year, absolutely incredible, wasn't it? The way that moved. So anything that's happened this week that you don't understand, or you want to talk about, your ideas? I'll have a look at my weekly preview prep, see if there's anything in there. You think you're getting into the gold? Oh, be careful what you wish for. It's quite a technical price action, so it's definitely worth playing. But there are a lot of things going on in its path that, like, since the start of last year, 23, this thing I've gone on about for ages, the whole Bank of International Settlements, Basel 3, where central banks physically have to own 85% of the gold now, which is why physical is something they have to look at. So the majority of historically, the majority of paper trading on the COMEX and London markets was 96% paper delivered, only 4% ever contemplated physical holding. Well, that is now becoming a much bigger number. And so a lot of the open interest has disappeared, which used to give you big signals, mainly because they know they're going to have to deliver something that they don't want to be involved in. So it's making the job harder to manipulate it via the paper market. So you've got different forces at work there. And I'm trying to encourage people to look at the CME data, the delivery data on a daily basis, which gets released overnight, about 1:30, 20 to 2. That will tell you what's going to be delivered. So people have an intention notice when they've an intention to supply, and then when it's stopped out, that is when the buyer has demanded delivery by, and it's a 2-day process. So I'm going to show you the chart in a minute. We might as well go to this now. In the trend for the year, in some of the periods where the gold has been really well bid, is when the physical contracts are bid. That gives you the relationship. And literally, you can sell a cash settling trade if you want, but if somebody wants to own it and asks for it, you're going to have to find it. So it's very difficult. People try and manipulate the market and force out the real sellers. But at times when this happens and they can't find it, that's when we get the big squeezes. There's been a couple of things we've looked at to show that, which is the leasing rates for gold when they become really detached between 6 and 12 months. That shows you that there's a problem, and they're normally just inside LIBOR rates, but that's been an issue. I'll try and reproduce that for the weekly. And then you've got central bank buying, which people have tried to smash the market whenever China says they haven't been buying any. But I'm about to show you the first 3 days of August, lots and lots of gold contracts have been asked to be delivered in physical. That's got to be central banks. Now, we're about to get the August data, possibly over the weekend, from some of the central banks. It's either this weekend or next. And July overall was quite a small month, so these figures may still not show up as Chinese buying. There's been buying by other people, but hopefully people will, like me, tie the two together and go, well, they are buying, because let's have a look. You understand gold tends to go on its own way, doesn't really correlate. Well, the thing is, people always try and pin it down to one thing. You can do a chart where there's positive and negative correlation between gold and the dollar, so it's not a given either way. And you get periods of panic where everything correlates as one or close to it. Anyway, that includes bonds and stocks and dollar and whatever. The geopolitics plays a role. Real interest rates is what normally drives it, not just interest rates. It's the whole inflation mix. And if you feel the reason why, if you think inflation is defeated, you know you're going to get big changes to real interest rates. And then in this environment, if we've suddenly got to have 50 basis points plus at a time, then that is a massive change. That is a kicker, because as you see with the 2-year yields, they'll all drop to close to zero, and there's no opportunity cost of not holding gold. And yet with gold, there is an opportunity cost of not holding it. If you weren't holding it from December, you're 25% down, aren't you? So, I mean, in fact, since Bretton Woods, it all depends. People pick whatever period suits them normally, but since Bretton Woods, it has, and since the 80s inflation breakout, it has returned about 10% a year on average. So it's not to be sniffed at. And then obviously we're in a secular bull market at the moment. We're in a super cycle event where the demand is far outstripping supply. And then the other thing in the mix is, as we know, the unit, the BRICS currency is coming soon. We've got the conference in October, so September itself may be a release date. And that is also using the Enbridge platform of BIS. BIS are the guys that manage the central banks purchasing on the other side anyway. So it'll be interesting how they formulate the ownership. If you've got 85% for reserve asset status, well, you need to have extra gold or be able to use the same gold for pledging against the unit. Yeah, it's to be seen. Be interesting how they do the dynamic. If, as it looks, the bias to gold ownership is in the east, then it's in their incentive to make it a buyer's market, which is just another bull side to the argument, but we shall see. Anyway, can everyone see the delivery report? So the one I'm showing you there, that is gold year-to-date deliveries that are called for 1 month by participants, and all sorts of people that are clearing banks, agents, some of the agents for the Fed. It's about this. A lot of the major investment banks are involved. JP Morgan, Bank of America are the big manipulators historically. And then when you see an H on it, they're doing it for their own account, which either means that they've got a position to cover or they're taking a position. Either way, it's normally when they're having to change their mind. But in aggregate, taken up, we've now got, look at this, January was 15,000. We had the move, consolidated February, broke out in March, consolidated, another breakout, May, June, we went through the consolidation, July, so where are we? January, February, March, April, June, wrong way around. That was December breakout, wasn't it? Yeah. December breakout, consolidation, January, February breakout, consolidation, March, April, May. I'm going mad again. Can't count, can we? Let's go backwards. August, July, June, May, April, March, February, January. Yeah, January consolidation, February outbreak, March consolidation, April breakout, May, June. We came off the low, didn't we? We had a lot of volume, smashing it down and then buying it back up to all-time high. July, sideways. Look, only 3,759 contracts, second lowest of the year. So hidden within that, is there any central bank buying? Possibly we're going to get this whole nonsense again about them not buying. When look, first 3 days of August, so by Monday, 16,455 contracts, and these contracts are for 100-ounce bars. Okay, so that's 1.645 million. There are 32,000 ounces in a ton. That gets you 51 tons. That's some proper serious buying in the first 3, or asked for delivery in the first 3 days. Now, it may be that these contracts took place in July, and July 26th was the end of the July contract. So it could have been the end of last week and the start of this week, potentially, when those took place, and asking for delivery into the end of this week and next week. So they could sneak into numbers, but be aware that if anyone tries to tell you there's no buying going on, there really is. Now look, the highest one for the year was the June number at 30,000. We're there in 3 days. A very good chance this is going to be a super month, which again might tie in with the fact that something's about to happen in September. Does that make sense? So on this, from my lens, how would I read this? What raises eyebrows in terms of talking about deliveries or market as a whole? So this is the page. If anyone hasn't taken note of it before. You find that in clearing operations and deliveries, if you go through all the the menus when you first go into setting, etc. And this was the overnight report. So there's 6,000 more or less required to be found by Monday, delivery date, 5th of August. We still don't know how many of those 10,000 have been found for today's delivery either. Probably half and half. Just some needed to be delivered on Thursday. So, as I said, that is making me sit up massively to see that amount of volume at the start of a month. And I don't know if people were listening yesterday, but when I was going through all these figures and open interest a couple of months ago in the June contract, when we were trying to find out, all of a sudden towards the end of June, things just suddenly stopped. The Fed they've managed to knock the market down on those contracts slowing down intra-month, and a few weaker data points were seized on, or data points that were suggesting rate cuts were delayed. And I looked at the open interest expecting it all to be pushed back into July, and it wasn't really, but there was huge new open interest in August. Which I said at the time, we need to look out for, is that where the delivery is being pushed back for? And intentions thereof, because a lot of these contracts don't have to be written in the month that you're in. You can actually trade in outside months. So it may well be that a lot of the buying that was taking place was down the curve, down the calendar, through the calendar. Either way, it highlighted why we should be looking when we get to August at the data. And now we look at it and it is going banzai. So I think that is the underbid for all the pullbacks in gold. Like I said, what we've done today, we've jumped up on the data and we're retracing. That's filled in a gap that we're looking for up to that sort of just shy of the all-time high. Now we'd allowed for this even coming back to 24.30 probably, where there's been a lot and multiple touches and demand. And that may well be where the physical orders are sat at the moment in gold. By the way, we do seem to be at the moment confirming that we're still in the uptrend. That was the key that we were looking for. So yeah, you can look through the commitment of trader reports. The problem with gold in particular, as a physical market, the Fed have historically used it as a way of supporting the dollar. So they will sell gold to bid on dollars when we know that the dollars are super offered. But definitely use the COT. The issue you've got is a lot of the substructure. So say there's a substructure in 500 million contracts. There might be 2 million contracts in the paper world off books. There's a lot of OTC stuff in this area. It's difficult unless you're a market participant. Even then, they've made it super hard to get all the data. They've hidden it around the world, and not all of it gets physically published, but they have to do certain amounts of physical showing, which is why this report, official report, when that is showing signs of strength, there's an even bigger picture going on. So I will I'll have a skim through the COT reports at the start of every week or whenever, and it is useful to see who's doing the buying and selling. So like gold, for instance, a couple of weeks ago when it was doing all-time highs, a lot of the buying had been managed funds. So you just know that if market makers were short, they were going to use any opportunity they could to bang that back down, to get the shorts back. And it was right at the time that some of the rotations came, so that you knew there were loose hands in the market that were likely to be sellers. So we ended up with a lot of volatility. This is now interesting again because we're back in the hands of physical buyers. This is how it moved when we were in that coming out of February, March, April move, when it hardly ever gave you a chance of getting in. The physical guys just wouldn't step away. So we need to see, is this an acceleration? Because then we really will get a proper breakout. So yeah, I mean, Pav, all these tools they're all just new confluences and layering on the fundamental side, and hopefully tie up. We're looking for where they tie up with where the technical picture is. So it will often be the deciding point on whether levels hold or not. Boom, boom, boom. So is everybody okay with where we are on gold at the moment? I think it couldn't be clearer for the minute. So just on the daily basis, we're still within the 234 channel. So this is still a valid fifth wave until we take out a 7th of June low. We said it may have been overlapping, but there's probably a sense of ones and twos within this. In fact, this current high on the 17th of July might just be the first wave that we've been consolidating, in which case we've got this potential breakout on extra volume. It's all about putting in a new higher high for the move, to me. So the yellow line there on the hourly basis, that's the all-time high. We're toying, we traded off this previously very strong sell-off zone. It faded that. We've now tried to go through it again, and we're struggling, but the fundamentals and the data is giving it every excuse to be able to do that. So at the moment, it's either a case of the all-time high was a wave 3, wave 4 to the bottom of that channel. Have we put in 5 waves to yesterday's top and done a small consolidation, or is this all still part of the fifth wave of this and the one yet to happen? So we should have some consolidation ahead, but I don't think it will be particularly massive from everything that I said, just from the nature of where we are. Fifth waves generally in commodities have lots of extension in them, which is something that's going on. We're looking for that original 2550 fib level and the top of the 234 channel here, and sometime next week or just beyond they merge. Then the overall, wherever this tops out, is where this minor wave 3 is. The channel for that is a big overthrow of the current waves channel. That can happen. Just needs extending across. So this all could ultimately get a breakout to 2600 really to still be in line with where all the previous waves were breaking out. All these wave threes can extend. That's where the majority of the work gets done, and we're very much in the latter part. We're in this black fifth wave, and we're just deciding where we are in the subwaves from that. It's actually he's over here. So in the fifth of the fifth of the minor wave 3, which is the big moving day 1 really. Moving from this wave 3 for quite a while now. It's a green one, isn't it? There you go. Yeah, so this is all the way back from the December lows. All right, this wave 3. And within that, we're channeling the minute wave 2, 3, 4. which is the May high to the June low. We've since put in a high, which is part of the fifth wave. Some people have got that at the moment as being the end of the whole move. So it's quite important at the moment that we put in at some point within this next few days trading range. We do need to put in a new higher high, but as I said, we're approaching, in the first instance, what I've got labelled as a lower degree wave 1. That suggests a wave 2 before we go higher. So there could be another pullback. But previously, they have been shallow. You're going to stick to FX? Oh, that's a shame. Everyone loves gold. It's very technical. So that's my kind of ideas on gold for the minute. So still think we're in the latter part of the overall minor wave 3. Just how we get there. And again, everyone that really listens and knows Elliott, 2 can be a big retracement. As long as it doesn't take out that previous low, then we're okay. So we could even come back to the channel here, 2380s, 2400, but I don't think for the minute that's going to happen. I still think we're here, 2430 is the idea. This support level, wave 4 here, I think is a favourite to hold it, 2430s. Which I think a number of people, for various reasons, on fair value gaps, order blocks, mitigations, check out Lucian and Gustav on my chat. They've got those all labelled up. Shabazz, hi. Any questions from you? So we may be on MACD measurement, we might be close to this being a one top and having some consolidation, because look, you've got the peak and momentum in line with the 3. We've had a new high with a lower momentum. So that is a classic for a small turn. So we are close to having a consolidation leg here. And then looking at what's got to be delivered by Monday, the Asian session in Monday, they may be quite important. You're still holding euros long, so it's all a relative argument now, isn't it? What I've been trying to say, if the Fed suddenly have to go, the ECB have more or less set themselves up to be in line with whatever the Fed's going to do. The Fed is a market slowing down, whereas particularly in Germany, the ECB have got an economy that's in recession, if not only just bobbing along, with a tiny bit of pricing pressure, which is coming off. So what I mean by that is, even though I think that the dollar is in a downtrend and the euro, by definition, should have an uptrend, it may be negated a little bit by the fact that they're going to go. They're probably going to match step whatever the Fed does. Any resources or books I can recommend? I've done that before. Can I put it? I'll put a list again on my chat later on. I mean, there's a lot of generic stuff you can go to. Some people fiddle around with it. Don't just get tied up with what the books say, because a lot of it is utilizing some of the tools, like the trend channels and equal legs for pullbacks, which is the most prevalent relationship for pullbacks, is important to have as like your base case. But obviously learn them, because there's loads of different setups within those consolidations, more so than the breakouts necessarily. Lots and lots of rules which aren't necessary to be. Don't get so hung up on them having to work. It's being able to literally delete the ones that aren't working. So it's a game. It's like a negative probability game. You can get yourself in the ballpark of where things are going by removing the options that can't happen. That's to me is where it becomes quite powerful, because it keeps you in the sentiment of more than one option at a time. And then by definition, with anything, you're not going to be right all the time, but you're narrowing it down so that when you are right, you should be in a powerful position. Pav, you think it's doing a Wednesday, the 20th of March interest rate move? What do you mean by that? They're not going to move until March. So at 2 o'clock US time, what is that? Are you talking about? Sorry, are you talking about today? Okay, right. So that was in this uptrend here, which is part of a consolidation, wasn't it? 20th of March, 2 o'clock. Yeah. So where are we with that? So it's still the same situation we had. We've done a double extension there, haven't we? And we're breaking out, but we need to get a higher high now, don't we, to finish off? I think that's a fifth wave breakout. It may be that we have a little bit more upside to come. Where have we got to get to? 109. We still have to put in that 110 I've been looking for, and then we break down. It might just be that it's higher scale. When we were in that previous move, that was a sort of C leg of a lower scale of a B consolidation leg. It was a third leg before we had a bigger drop. Yeah, so to me, we're at the end of we're in the latter stages of the powerful wave up. So the impulses, the upside tend to be important. So we might have a pause down leg, like say, we can make a case for having a connector. This could just be the first part, the first 5 of the way up, connector, another up, a connector, and then finishing off. But short term, the bias is going to be people won't come round to the idea of the ECB going in lockstep with the Fed until down the line. That's just me. So that the differential is in favour of the euro, isn't it? Because the mantra is going to be, the narrative is going to be that the Fed might have to do 50 basis points. So that gets us. I mean, It's funny how the world comes out. We're flapping around trying to go, is this ever going to change to get us into the positive side of things? Even GU is showing issues, isn't it? We said we were looking for getting that too low in. I think we found it. Again, right slap bang on the 1.618. It's reversed. So what we were talking about yesterday, with so many computer programs playing in there with overlays of lots of indicators and technicals, there's an obvious, well used one that equal legs down to 1.168 as a maximum, and we've bounced right off it. Classique. Again, this should be a genuine start of the wave 3 breakout, because the narrative's exactly the same. And Powell's interview on Bloomberg today, just saying that they're looking for the narrative to change and confirmation of it, but they're not necessarily looking to do multiple rounds of rate cuts for the minute until they're much more comfortable. But because they've started, they've now got the flexibility of being patient rather than being rushed into doing what needs to come. But they had to get that rate cut in just to make sure that they had a data warranty to do it. And obviously, if the Fed does emergency rate cuts, everybody around the world can do whatever they want. That is open season, and has often been the global turnaround time. Just look at what's happening in gold. That's just crazy, isn't it? So I think the answer to your question is yes, I think there can be pullbacks, but I think the current lows are probably the correct ones, just because the rate cycles from the above the line, the GBP and EU aren't really going anywhere relative to the dollar. It's the stock rotation. We said it's all a bit of a mixture, because we're right slap bang in the middle of various seasonalities and rotations. The start of August is dreadful normally for value stocks in the Russell, and we were saying at the start of this week that move had got a little bit extreme. So yesterday everything was off, so there was no relative outperformance. Techs have been slammed. Instead, at the start, there's a mixture. The AI side of things is actually the only game in town, and hasn't been a disaster really. But tech per se has. Electric vehicles flatline to negative growth for the big players. The suppliers, STMs, ST Micro, Intel, all that crowd are actually really struggling on underlying demand. So their inventories have built. So there is an actual negative for the SOX, semiconductor index. So it's a two-way pull within the Nasdaq and some of the S&P, whereas the value should be outright just selling off a little bit. This growth scare isn't just a blind read through from employment data. It's looking at not only US and manufacturing, which is just a small part, but the actual updates from companies. So you'll notice that I mentioned those on a day-to-day basis. I give a little brief comment about the big ones in the weekly preview. There's a reason for that. We talked about before. It's those things give clues not only to underlying sectors and then therefore the indices, but underlying clues for actual momentum in areas of the economy. And that does actually is where you get some micro and macro crossover, which is again why it doesn't really pay not to have an interest across a number of things. This means that your workload to be on top of things is massive, but it does help, and it gives you clues where to position or where not to position. But net, apart from the occasional stock which is outperforming for various reasons, the message has been a slowing economy and the consumer no longer paying high prices, and that becomes a feedback loop. So margins start to get hit by companies because they can't pass on input price rises, so they don't demand. The demand goes down. The demand for the inputs goes down. So you get your PPI going down, CPI goes down, and as people were saying earlier, if you had to raise interest rates 400 basis points to try and stop this inflation breakout, if the economy is actually stalling, how far do you have to cut those rates to get it going again? That's at least 200 basis points. That is a lot of underlying support and a lot of underlying support for the bond markets, which we talked about. There's a reason, there had to be a reason why a lot of the money was coming in. Those economists always look at things from a debt perspective, from a servicing, for solvency, bankruptcy, blah, blah. They spot trends often a lot quicker than analysts in the equity markets who are more bothered about being ebullient, talking stocks up, etc., etc. I'm not even on camera. So even though they're looking at the same thing a lot of the time, then they will be often not necessarily looking at the right things. And again, that's a good discipline if you get a chance of learning to look at stocks for in terms of bond perspectives and solvency and covenants, things that you can't allow to happen in the company or you have to give the money back. You suddenly see different chains of behaviour than you do with people who invest in stocks, where the worst thing that can happen is you lose all your money. You get different behaviours, which is why you get different risk profiles. Always good to compare as much as you can. Anyway, getting sidetracked. Where are we? The dollar. So I said September interest rate cuts. Yeah, I've been one of the few saying that they could go intra-meeting and might have to. That's becoming ever more to the narrative now. So look out for the next week or so talking about that. In which case, it's all going around in circles here. But in which case, if you get the rate cuts coming quick enough to rescue the economy, then rate cuts help smaller caps again. So we might end up having, if they come quick enough, we get the rally earlier than we expected for the whole market. The seasonality is a guide. It doesn't have to play out completely. Remember, we want the seasonality for the dollar in April was for pullback, and it managed to just sneak up by a couple of basis points above the flat line. That negated the seasonality effect. Yeah, in fact, it was just setting up the fall of the next few weeks. So things can suddenly just move, a couple of weeks, a month. Doesn't seasonality charts don't have to necessarily play out. They're just something to be aware of. So yes, dollar, we talked about it earlier. We had the little impulse down, haven't we? We've been waiting for it. We had a 3 waves move there, which we talked about the other day. Said it could potentially go up to 104.70, but doesn't have to. We didn't think it would. We're now in fact, that moved across very slightly, didn't it, to there? So we're now into a third wave. Had a consolidation, subwaves 1, 2, 3, 4, 5. So it's winding its way down. It's going to be volatility. The idea for me was that we were going to break just beyond that 1618 just to prove that it was impulsive, and maybe a stopping point for the move is 102.40 takes us into August. The idea was that when the dollar then puts in a consolidation, it is lining up with what would normally be slowing risk on performance. This could all now develop a lot quicker. Remember, it's one of 5 waves down. This consolidation wasn't going to go to new highs. It was just a connector. It may well be that we have a much quicker move to 1 consolidation, and we've got to get all these rate cuts perception into the end of August. Either way, the trend looks to be going the right way impulsively. So we were here on Monday, weren't we? Saying we're in a consolidation for bonds, which looked like it was just beginning to do some nesting. suggesting breakout, all on the back of the bond inflows and the backdrop and the data, and you've had quite a nice move. So a nice bit of geared 10-year note action. So basically, for a perception of what's probably about 30 basis point move, you've had 3 big points move in the index. That's gearing for you. Duration, as they call it. UJ, all I can say there is hopefully you're all safe listening. You said it was set up for a move either way. Where were we? Back here, weren't we? It was just putting in the second leg of the connector. We said 152 must be your get out if possible. And that happened on Wednesday through the decision. Now, I've got a hands up, as I said at the time. I gave them a lot of criticism. Didn't think they would. Thought they were going to walk away completely from doing anything. 15 basis points was my requirement. Aggression more than the 1/6 pullback in purchases to 50%. Massive tick. Talking about not being an upside to the, and this is really good to know. Central bank can directly ask the question: Is 0.5% going to be the scale of it? Absolutely not. There is no bound, and we don't think there should be. Blah blah blah. All the right language, completely opposite to what happened at the time of the 10 basis points move. So a lot of confidence, data kind of supportive, and they're waiting for any further help from the dollar side of things, Powell, et cetera, et cetera. So fundamentally, that is going to plan. Everyone, if you were playing for the bounce, you're out at 152. In fact, if you look at it, when I was looking at it on Wednesday, I actually talked myself out of selling this just because I didn't understand what I'd missed as to why it was bouncing. And literally, it took just some extra questions and answers from the wader to sort that out along the lines of there is no upper bound. And that became the proper breakdown. As I said earlier, the way that strategists look at UJ is in this fair value term, the longer term relative to where rates are. If rates are coming off 200, 250 bips in the States, then UJ goes to 100 or well on its way. So just make sure you're all over UJ's fundamentals before you start gambling on that. Hot again today, isn't it? So that's UJ, blah, blah. So I'll have to think on what could happen there, because to me, with the fundamentals changing, this puts the fifth wave under a lot of investigation, a lot of difficulty. So that would require another break into the 160s. So the only way we're going to get that is if the Fed does start holding on, doesn't cut rates, get a couple of data points going the other way. And UJ have set out their time frame, but they can't. There's not really a lot more that they can do in the short term. Plus, they've sold a lot of UJ in the intervention supports. They might be forced to take a bit of that off if it became a runaway train the other way. Now that is low case scenario, so I need to have a look and think how that might have actually rolled up to being a fifth wave top up here, because this is getting relatively deep. Still got quite a lot of potential to get back to where it all started, which is way over here. 140s, but it's not in the context of what's happening. It's not impossible. So I'm going to have another big picture address of that over the weekend just to make sure that 3 isn't actually 5. Blah, blah, blah. Anyway, that's the power of it. It's all the same fractal. It's just working out which one we're in. The higher the degree of fractal, then the deeper that the pullback can go. This pullback obviously is deep at the moment. It could be a higher degree. So they're the sort of things that make you suddenly you're not wrong per se. You're just wrong in terms of scale. So it becomes interesting. I think it is anyway, and helpful. The victim, the sad old victim, just because of the nature of the levels, is the Nikkei 225, which was the breakout index for most of the year. But again, just like the yen itself, the retracement is getting ever deeper. And even the second leg is now, where is it? It's on its way to 34,000 would be equal legs from the current consolidation high from the top. So it's done everything. It's a lower low. It's in the band where it can start turning round. But at the moment, the idea is the strengthening or the weakening, so the strengthening yen is affecting the export side of things. But if anything, the exporters agreed that at the margin, they've gone beyond helpful. And we're getting back towards more sensible equilibrium kind of rates for the UJ short term. But they've also got the tech idea caught up in the Nikkei, and it's also because it's been an outperforming index, particularly if you'd hedge the exchange rate, then that's one of the places where there's a lot of gains to be unwound. Plus, the whole dynamic of unwinding carry trades, you're never quite sure what is where whether it makes people just de-risk anyway. What it hasn't done so far is attract the buyers in, but it must be getting close to a level where it's even a trading buy. Once you get to this equal legs here, it's a trading buy with that as a low. It's even a trading buy with that as a low here. So it's an obvious stopping point anywhere 34 to 33,000. And you've got the added bonus at the moment, while the way things are playing out, is that the idea is that the yen strengthens, so you get the double whammy as an overseas investor. So it'd be interesting to see what people do. Just as I showed it the other day, you didn't get a 1-for-1 protection, but you would have done being protected in the currency side as the exchange rate, as the index fell. So you'd have trying to catch the knife of the index by converse would have hurt you on the FX side. So right, Planty, you'd have won on the FX side, you'd have lost on the index buying it on the way down. Now that you're near the end of a pattern, it starts to become safe, and you've got the FX potentially on your side too if we get a bounce in the index. Germany, this again will be, I think it's time to redraw this. The main reason being complete lack of impulse since we're in this 3-4-5 channel, but it's just when we thought there was an overthrow and we're going to go back in, which was mid-July, that's fine, but it's rejected it and going down. I think what has happened here is this wave 4 has just become one long, complicated sideways channel, which we can draw. It still hasn't put in a lower low, and it can do. we have had a high, so it's an expanding flat type nature to some of it. I think I'm going to relabel this as being WXY or A. Just keep it simple. Three swing move in A, B, and C. This is potentially from this top here. Going to work out as 5 waves down to the end, or there's another connector. It's very complicated. I'm going to have to redraw the whole thing. But what I'm trying to say is it's trying to find its wave fall low the last 2 months. There's been obviously impulse both ways within it, that always without making any real progress either way. That's telling you that you're in consolidation. So that is telling you that 4 really needs to come over here. So that will take place. Again, that means we're probably closer to some kind of trading breakout, whether that is the start of wave 5 or continuation of this pattern. That we'll have to find out, but it does bring back in, just like the Nikkei, trading buy time isn't far off. So this is the previous low, yellow line. Doesn't have to hold that to be part of this 4. That makes me a little bit more comfortable than trying to second guess the pattern we're in, which has been awful. But I think we're coming towards a turning point. But I'm going to look at that again. You'll have a fresh chart for Monday. FTSE, we said a similar thing, didn't we? Didn't think it would have enough momentum. But I was getting a bit scared about that on the first start of the week, first few days. But didn't put in a new high, instead turned down. We kind of thought that was a meandering sideways, and that does still seem to be developing a little bit. But again, that could be into the next stage up. It's a 1-2. Need to tidy up whether that daily basis chart is actually is this the genuine fall low, and we've had a move up. At the moment on the daily basis, it only looks like a 3. Is it 1, 2, 3? It could be a 5 wave leading diagonal, but I don't like making everything a leading diagonal. So we'll keep open the fact that that could just be a 3-wave connector, and we're putting in yet again one more low for the move. Keep that option open, but because there's no high yet, to me it's still in consolidation. That's interesting to hear, Pav. Nice to hear from you. Thank you for that. Recalibrated it. Yeah, I mean, it's one of those times when you can often try and backfill fundamentals into the technical. Often you do that the other way. That's why I don't ever like hearing somebody just say they're fundamentals technicals traders, because I think you need to have a combination of the two just to make the whole thing just have more complete confluence, and to give you more reasons for knowing when to cut, etc. Yeah, that's interesting. Equally, I'll do a redraw of it and tidy mine up for Monday as well. So the hourly, but it's a genuine 5. You can make that a genuine set of 5 swings up if you wanted to. Then a consolidation, but you could equally make that an ABC connector. The jury's out for me on FTSE at the moment, and in terms of stop losses either way, we're right bang in the middle. So again, I'm staying with no trade in the FTSE until we're closer to one of those extremes. Actually, I haven't played with the Dow for a bit, so I've not even updated the chart. All this moves across here. So we put in a 3-wave. That could be the bottom of it. Then we've had basically a 3-wave back, 3 swings. And then there is an argument that this could be finished with a new lower low, in which case 2 is here, and then you've got 1, 2, 3, 4, 5, 6, 7, 1, 2, 3, 4, 5, 6, 7 down. Potential for Dow, potential that that is a low, but I'm not convinced on that. It looks like a very, very choppy thing. Yeah, I'd expect there to actually be a connector here and then another leg down, potentially for the Dow. So potentially 1% plus just to get into that zone to complete the equal legs, if that is a three swings at a high degree sort of move. It is in a valid turnaround point, like I said, because it's got a new lower low. But I'm not convinced. You know, I'm not convinced on the Dow at the moment. The makeup isn't hasn't been great from the underlying. So again, I'm not advising anything in that or suggesting anything. That is another. That's a work in progress. The Dow. Nasdaq's interesting because again, I've been doing various channels at various levels, equal legs, pullback. Was always this 18,500 level. We thought we'd send that off with this bounce, but no. So there is potential for further downside into this zone here. But again, because we've got a lower low below the equal legs, there is enough in there to suggest that it's valid. It's just whether you believe is that whole thing, you know, 3 sell-offs on the same thing. Is it have we had a cathartic sell-off, or is it now is the growth scare in combination of the harsh hits to AI versus legitimate SOX in general issues, is that enough to get Nasdaq 100 any further down? We've had rotation into smaller cap. Did that take account enough of semiconductor weakness at large? It's mixed. It's mixed for me, and I think I'm leaning towards it. I really am leaning towards us being in a bounce zone. It's just literally finding where that is. That's the daily basis. Good. It just this is a lot on the fact that you've had a lot of capitulation already. And you've got a lot of people getting bearish right at the bottom, just as the rate cycle looks like it's going to have its hand forced. And absolutely hugging the 10-day. That's not, is it? That's the 10-hour. We don't want that. Yeah, it's a 10-day moving average. That is 240 hours, obviously. So we're trading well below that at the minute. Don't know. It's running out of steam, isn't it? that is the usual pattern for a consolidator. A low, a high, and we've got the lower momentum low in. It's a potential turning point right here, but be very careful. I think I want to see a little bit more capitulation. I think, yeah, I agree with you. I think euro is going to go up until we get to the point where they cut, until the US cuts rates, and then we need to have a hard think about what the ECB are going to do in reaction, because they're desperate for a reason to cut. So the most extreme point, if Tuesday night's low was the end of the first leg down, and I said we're surrounded by cats, dead and alive. These smelly cats here, dead cat bounds, and we're now looking for the final leg for a lower low, and we're looking for 5 swings in that. I mean, there's potentially 1, 2, 3, 4, 5. This is what I'm saying. We could be in the end point. Generally, don't like to call a turn before the spot 618. So that gives us another potential for another little bit of sell-off. And if it gets completely extreme, we're looking 5% off. So it's kind of danger zone. You're catching knives at the moment. We're close to what is valid for a turn. We're just outside the long-term trend channel. This blue line here. So it all depends on your risk threshold. If you're short-term trading and blah, blah, then it's tough in a minute. But there's everything in place, more or less, to call a change. I want to see some momentum change properly. And it's worth waiting probably to see that momentum get back to 0 as well on MACD, just to completely convince yourself. But we'll wait to see. What you got going on here is this hook idea. It's often a bluff on MACD with a signal line. What you want to see is this blue line threaten to come up, false to go down, and then turn up, which is a slingshot. That's when you want to be buying the turn using the MACD. So Nasdaq slightly closer to being a buy, but want a little bit more evidence. Oh, what was that in factory orders? So yeah, factory orders for June in the States more or less confirms what we heard from ISM yesterday. Really, that's really starting to show advanced orders slowing down. So that's June. We got data for July yesterday that was confirming that trend. Again, if you had to bet on what that figure was going to be, you would have said that was a miss based on what you were reading about yesterday from ISM manufacturing. So yeah, S&P again, we're in a similar state of affairs here. Hello, R2D2's friend S1R4JX. I'm very well, thank you. So again, we've got a classic 234 channel that has been crossed and just had an overthrow. And it's still within the 1 to 1 spot 168 equal legs idea. Um, Again, I might want to tweak that from what we had on Monday. Let's just, for maximum bearishness, let's say that's the low. And that's the high. So we're still valid, and the equal legs is just a little bit lower, 5278, a couple of percent away. Another 2% downside sort of sits with that 2% downside of the Nasdaq we were just talking about. To still really stay valid for coming back into this channel and finishing it off. So again, I'm not going to necessarily jump into that just yet. Maximum momentum for the two peaks of the connector sequential yet, and on the way down, we've now got a lower low in place than the previous MACD at that turning point. So that looks like the right thing to have done. It's just a case of have we got the lowest MACD in place for the move as a whole? We're close. Everything is valid for a turn here. It's just a case of waiting for timing. So I would probably myself drop down into those Bollinger Band zones that we talk about on all these, just to wait for walking up, getting them into that 2 standard deviation zone and seeing it walk up. So another one, pencil sharp, but it's all about timing. Let's see how we react. So that's the 3 of those. Anything else? I said before, Brent, the demand implosion has totally negated what we were talking about. And we said, don't trust this anymore for doing the double extension for wave 2. The demand implosion we're seeing looks like it's coming through. We talked about this whole China thing here, just suddenly going more than we wanted it to. A couple of weeks ago, remember, we broke to a new low here. We've since gone to challenge what was the previous low. Have we taken it out? Very, very close. Obviously, a lower low would probably, it could still be an expanded flat that takes us to a high, but it becomes at best second case. If we get a lower low, then we should really be in the wave 3 down. And that is proper demand destruction time into the 60s, 70s, the place where nobody wanted it to go. There would supposedly be a lot of action taking place to try and support that. Maybe we need cuts from OPEC if you get sub 70. So it continues to be a pig. Avoid. And guess what? You never got to saw that, did you? Yeah. Getting tired. Sorry. So this is Brent. We warned here when we had the break of that low, that connector low that we thought could get us potentially the most bullish scenario would be an equal legs consolidation. But we said if that were to break down, and we were talking about that around this time on Monday the 22nd, it's carried on breaking down. We're now just about holding on to that low. As I said, we could potentially bounce. But that's the most extreme flat that you're going to see. They do happen just to completely try and catch you out. But really, a lower low, even though it could still be an expanded flat, is more likely to break down here into the 60s. Alphabet man, do I trade currencies? Sometimes, but mainly when I trade myself, it's indices and commodities. But occasionally I do trade UJ and things like that. Sometimes, occasional EU, not a lot. That's just my background, really, but I'll analyze them and look at them. So last couple of charts, and then I'll release you. Where are we? Just the old favourites. Nothing really going on in volatility-wise. The bond market volatility, that's going up mainly because we're getting this rotation within the curve. So some are negative, some are positive. So that's an increase in volatility. It's not a one-way trend. It's been a reversal of the inversion. Volatility, we said panic time if we get towards 20. We've had that. Guess what? We've got panic time. It's a breakout of the channel. Obviously, we'd like to see this calm down a little bit. Might pay to watch this just start to calm down, miss the first 50% just to get confidence. But at the moment, it's very much people are buying protection by the look of it because the volatility is going up. Implied vols normally when people are buying the protection. Excuse me, price goes up. And just to put that into context with what we were talking about, this is that channel. We'd still not broken it for the week ending last week, but this week it's obviously broken through. And on a daily basis, we didn't break it. We wicked it yesterday. Today is the first time we've really broken out into the 20s, proper risk off, worries, the downside protection, right up in the world economies. But I think from what I've shown, there's obviously potential for further downside, but I do think a lot of it is very close to some short-term turning points, even if they are just connectors again, and then we can readdress. I think necessarily getting bearish right on the bottom of trend channels isn't normally the way you win, unless it's super obvious that the trend has finished at the other side of the channel. For me at the moment, I'm still labelled as wave fours, so I need a little bit more evidence that those wave fours are no longer in play and that we're at a higher degree. So I'm ever vigilant for changing that. But at the moment, benefit of the doubt until the latest supports give way. Silver's just following gold. Nothing really happening there. New York Stock Exchange advanced decliners. Obviously, we had the sell-off on Tuesday, bounce back on Wednesday that had positives, and then sell-off again. So that was rotation still on Tuesday, which was probably about right, wasn't it? Wednesday was tech rebound day, and yesterday was everything's a dog day. So it'd be interesting to see if we get either exhaustion in that or we get a return to green. In here, it's a bit no man's undecided land, hard to differentiate. So we'll have a look to see what that ends up over the weekend, because you may get a big move later in the day that defines exactly what's happening there. So that for me is, I'm sure you'll say enough. Hopefully some of that was useful. We are on the gold deliveries. The physical market has got mitts all over that one short term. And for the rest of it, just be careful. Make sure your stop losses are reasonably tight. What I would do with the way that the volatility has gone out, advise you to just take your staking down to allow for the wider volatility. Otherwise, you're just going to keep walking into stop losses. But don't get giddy. Make sure that you're in survival mode. There'll be plenty enough chances to chase this, or to chase it up or down once the trend affirms itself either way. But at the moment, just be careful because we're on a potential pivot point. Anyway, hopefully that was useful, and we'll speak again on Monday. Take care.